Welcome to Chart of the Day. I'm Robert Folsom. Long-term commodities, price turns, and opportunities. Let's look at commodity prices in the long term and in the very long term. Then we'll mention the implications for the near term, where the opportunities will be. As for the long term, this is the monthly CRB or Commodity Research Bureau Index from 2008 through early 2021. The index includes 19 commodities, from metals to grains to softs to livestock to energy. You can see at a glance how the CRB fell from this 2008 high through this early 2020 low, a 78.6% decline. Now, you may recall that the 2008 commodities peak came soon after a long-term stock market peak and the beginning of the Great Recession, which in turn led central banks worldwide to pump trillions of dollars into their economies, aka quantitative easing. With 2020 hindsight, we know that with commodities and across most asset classes, price deflation followed, but at the time, the conventional wisdom feared inflation. And as an FYI, in 2008, we knew deflation was the real danger. In June of that year, Robert Prектер said a spike top was due in crude oil. Crude is the largest component in the CRB index. So this long-term chart is revealing, particularly this move up from the April 2020 low. But in terms of scale, our very long-term chart is the attention getter. This monthly chart covers 270 years of commodity prices beginning in 1750. Here's the 2008 peak we discussed, the large decline into the 2020 low, and the bounce into this year. Another date on the chart worth mentioning is here, some 40 years ago. That was when commodity charts looked like this, in February of 1981. It was the first chart of commodities Robert Prектер ever published in the Elliott Wave Theorist. The CRB had peaked 2 months earlier in November of 1980, so back to the 270-year chart, Bob proved correct about the turn lower. The CRB did not see the 1980 high again until late 2005. Just for reference, here is the Revolutionary War, the War of 1812, the American Civil War, and World War I. These were peaks in the commodity price cycles during the real money era, which concluded in 1933. In 1934, President Roosevelt outlawed using gold as a means of exchange among Americans, so the paper currency or accounting unit era followed, and commodity prices have reflected Elliott wave patterns ever since. Again, this is the very long-term chart. And from 1933, we do see a textbook 5 up, 3 down Elliott wave pattern. And that has very relevant implications for the near term. Note that the 2020 low in commodities fell into the same range as the cyclical peaks of the real money era. As Bob Prектер puts it, it may not seem like it when shopping at the grocery store, but we have been living at a time of very cheap commodity prices, quote unquote. If we look again at the CRB chart since 2008, this rise from the 2020 low is indeed relevant to the near term, and the fully labeled charts, plus the commentary in the March issue of the Elliott Wave Theorist, offer you a perspective you simply will not see or read elsewhere. In 1981, the Elliott Wave pattern anticipated the trend. In 2008, the pattern again anticipated the trend. Yet, as I said, the CRB index shows the broad trend in commodities, but the index itself is a basket of individual commodity markets. Traders and investors looking for opportunities in those individual commodity markets will find a wealth of coverage in our daily commodity junctures, our Energy Pro service, and in our eWaves flash services. Please see below for links to the right service for you.